Hey everyone, so when you hear someone say they own stock, what pops into your head? For most of us, it's just this one simple idea. But you might be surprised to learn that stock isn't just one thing. Nope, it's a whole category of investments, and each one has its own very different rulebook. Okay, let's dive in and really unpack what that means.
So let's just get right to it. What does owning a piece of a company, a stock, actually give you? Is it just a ticker symbol that you hope goes up? Well, the reality is it's about rights, it's about responsibilities, and maybe most importantly, it's about where you stand in line when things get real.
You see, stock is a super broad term. And depending on the type of stock you own, you might have a real say in the company's future, or you might have a priority claim on its profits, or you might be taking on a whole lot of risk. Think of each type as a unique package of power, potential rewards, and, of course, risk.
So, in the next few minutes, we're going to answer three really critical questions. One, who gets their money first if a company hits hard times? Two, who's actually calling the shots? And three, who's taking on the biggest risk for that shot at the biggest reward? By the end, you'll have it all straight.
Okay, let's kick things off with the most fundamental distinction there is: common stock versus preferred stock. Seriously, if you can get your head around this one core difference, everything else is going to click into place.
First up, we've got common stock. This is the one you hear about all the time. It's your classic ownership stake in a company. You get to vote on big decisions, you get to share in the company's growth. But, and this is a huge but, if the company goes belly up, common stockholders are the absolute last people to get paid. So if you want to boil it down, the formula is pretty simple. Common stock gives you the potential for big growth plus a degree of control, but it also means you're taking on the highest level of risk.
And now for its cousin, preferred stock. You know, the name really says it all. These stockholders get preferred treatment. They get paid their dividends, which are usually a fixed, regular amount, before any of the common stockholders see a dime. And that right there makes it a much safer, more predictable kind of investment.
So the formula here is different. With preferred stock, you get that steady stream of income and you're taking on less risk. So what's the catch? Well, you almost always have to give up your voting rights. It's a direct trade-off. You're swapping control for stability. Putting them side by side like this makes the trade-off crystal clear. With common stock, dividends are a maybe, but you get a say in things, and your potential for growth is, theoretically, unlimited. With preferred stock, you lock in those fixed payments and get paid out first, but you give up your voice, and you pretty much cap your upside. It all boils down to what you're really after. Are you playing for growth, or are you playing for safety? But wait, it doesn't stop there. Oh no. The world of finance loves to mix and match things, creating these interesting hybrids and special classes of stock that try to give investors the best of both worlds. A perfect example of this is something called convertible preferred stock. It's super popular with early investors and startups. See, you start out with the safety of preferred stock. You're collecting those nice fixed dividends. But if the company really starts to take off, you have the option to flip a switch, convert your shares into common stock, and ride that wave of growth. It's the best of both worlds. Income now, with the option for a huge upside later. And even common stock isn't always the same. You'll often see companies issue different classes, like Class A, B, and C. For example, a founder might hold on to Class B shares that give them, say, 10 votes for every share they own, while the Class A shares they sell to you and me only get 1 vote. This is the clever trick that founders at places like Google and Meta use to raise billions of dollars from the public, while making sure they keep an iron grip on control. So, okay, why do all these different types matter? I mean, really? Well, it's because they map directly onto completely different investment strategies. It forces you to ask, are you looking for long-term growth, or are you looking for steady income right now? Let's take a look at those two paths. So a growth stock is almost always a common stock from a company that is plowing every single penny it makes right back into the business. They're not paying out dividends because their one and only goal is rapid, massive expansion. For an investor, it's purely a bet on the future. You're giving up immediate income for the potential of a much, much higher stock price down the road. On the flip side, a dividend stock usually comes from a more mature, stable company, one that has really predictable profits. And instead of reinvesting everything, they share those profits with you, the shareholder, through regular cash payments. This is the go-to for investors who care more about a steady, reliable income stream than about explosive, unpredictable growth. All right, before we pull all this together, we have to take a quick detour and talk about one more category of stock that I'm sure you've heard of, but it comes with a massive warning label attached. I'm talking about penny stocks.
If you remember one thing from this, let it be this. Cheap does not mean undervalued. Penny stocks are shares of tiny, often struggling companies. They're incredibly volatile, they're super easy for people to manipulate, and sometimes it can be nearly impossible to sell your shares when you want to. Let's be clear, they are a gamble, not an investment. Okay, we've covered a lot of ground here. So let's bring it all home with one final, simple mental model that really clarifies the most important concept we've talked about, that constant trade-off between risk and reward. Just imagine a line of people waiting to get paid if a company goes bankrupt. First in line, the absolute safest spot, are the lenders, the bondholders. They get their money first. Next up in line, the preferred stockholders. And who's at the very, very back of the line? You guessed it, the common stockholders. They take on the biggest risk, but in exchange, they also have the biggest potential for reward if the company becomes a huge success. And that brings us right back to you. Now that you understand this fundamental trade-off, what's more important to you? Is it the safety and steady income you get from a preferred position? Or are you willing to take on the risk of being last in line for that shot at explosive growth? There's no single right answer, of course, but just knowing which question to ask, that's the real first step to building an investment strategy that works for you.